So welcome back. We are pleased that we have with us Chairman Hensarling, and let me just say that without question, one of the most pressing issues facing our country is the need for a new system of housing finance. This system, when functioning at its full force and potential, can offer millions of American families the opportunity to choose the type of housing they want and require. Unfortunately, the system is failing and far short of its vision, and it is totally broken. The government's overwhelming presence in the mortgage market crowds out private capital and places excessive risk on the taxpayers, who ultimately are on the hook in the event of a market decline. And while homeownership is more affordable than at any time since the 1970s, too few families have been able to benefit from today's record low interest rates and as they see their credit standards grow increasingly tight and keep them out of the opportunity to buy a home. So to help chart a course for a more sustainable mortgage system, we're really privileged to have Congressman Jeb Hensarling, who is joining us today. He was first elected to Congress in 2002 from Texas' 5th District. Congressman Hensarling has consistently fought to defend our families, strengthen our homeland security, and support our troops. And the Congressman has also been a champion of fiscal responsibility and helped lead the successful fight to end earmarks. For this work to rein in wasteful Washington spending to put our country back on a fiscal sustainable path, the Dallas Morning News has called him a truth teller. But you know, let me say, having been in Washington for a number of years, truth telling in Washington is a rare thing to see. So anyway, he clearly is one of the leaders of Republicans in the Congress, and he is currently one of the most effective leaders in Washington today, as he is the chairman of the House Financial Services Committee, and has been a strong advocate for consumer choice, competitive markets, and smart regulation of our financial markets. For years, the chairman has worked in trying to rein in the outsized role of Fannie Mae and Freddie Mac and the risk that it posed to American taxpayers. His warnings obviously came to pass as we saw the debacle of 2008. And so to attempt to put some clarity on this whole issue, he has proposed a very, very interesting and thoughtful bill called Protecting American Taxpayers and Homeownership Act, or PATH. And so this is a bill that has created more talk in Washington on this issue than anything else I have ever seen. And so it is with great pleasure that I want you to welcome our keynote speaker today, Chairman Hensarling.
Well, thank you, Mr. Secretary, for the kind introduction. I don't know if you can see me. This is a rather large podium. It reminds me of what I frequently tell my Washington colleagues: everything's bigger in Texas but me. And if you can't see me, at least you can hear me. Anyway, I was delighted to accept the invitation to speak before the Bipartisan Policy Center for a couple of reasons. Number one, because of the outstanding work that you have done in the housing arena. And number two, I live about 3 miles from here, so it took me about 7 minutes to get here. Anyway, the truth is, as a fairly new chairman of a standing committee of Congress, if the truth be known, I have a number of speaking invitations that come my way. A lot of press that's interested in speaking to me, but I assure you I do not have to work to remain humble. But because I have a lot of speaking invitations, I accept a number of them, and at this home I have about 3 miles from here. It was about 2 months ago, I was working on one of those speeches after dinner, and my wife, who helps keep me humble, comes into my study and says, "Okay, in Washington you may be Mr. Chairman, but in Dallas you're Mr. Dishwasher and they're not getting any cleaner." So I took my wife's subtle hint. I dropped the speech. I went into the kitchen. I began to work on the dishes. A few minutes later, the phone rang. She picked it up. She comes into the kitchen and says, "Okay, Mr. Big Shot, Wall Street Journal on the phone." So I thought to myself, I wonder how they got my home number, but I guess I'd rather be talking about quantitative easing than washing the dinner's dishes. So I pick up the phone and said, "Yeah, this is Jeb." On the other end of the line, I hear, "This is Chuck with the Wall Street Journal. Did you know for just $29.95 a month, you two can..." So I assure you, that will indeed keep you humble. Something else that will keep you humble is trying to reform our nation's housing finance system. It is something that I believe is vital to every homeowner, current and would-be, vital to every taxpayer, and vital to the future of our economy. And I know if you didn't understand that, you most likely would not be in this room today. So again, I want to thank the Bipartisan Center for the work that it has done on housing reform. It's very important work. And I especially want to recognize the outstanding leadership and service of people like Secretary Martinez and Secretary Cisneros, the latter secretary being a fellow Texas Aggie, and as I reminded him, as a temporary resident in San Antonio in the early 80s, my former mayor as well. But I'd like to thank both of you gentlemen for continuing in this facet of public service, and I thank you for the solutions you promote for our nation's housing challenges. And I also want to thank the Center for the work that they do in promoting a respectful and constructive dialogue on what is typically a fairly contentious issue. And we all know that in Washington, it occasionally sheds a whole lot more heat than light. I hope that today we have a little bit more light, and I'm pleased to be a part of that dialogue today. As some of you may know, I have focused a good portion of my public service career devoted to the issue of housing. I believe, as you believe, that homeownership is an especially cherished American tradition, and it's a tradition that I think we all believe is far more meaningful than landscaped lots, picket fences, or granite countertops. Home ownership is indeed a quality that can bind families together, build financial security, and strengthen our communities. But as cherished of an institution as it may be, home ownership does not, in and of itself, constitute the American dream. It never has. I think most of us believe that the American dream is something far, far more profound. Quite simply, the right to use our God-given talents, to control our own destinies to the end, that our children might have even greater opportunities, greater abundance, and greater freedoms than we have ever enjoyed. And it's this understanding of the American dream that serves as my personal compass in this debate. But before we can use any compass to help chart a path for the future, we must have a thorough understanding of where we have been and where we unfortunately find ourselves today. From my work on the Congressional Oversight Panel for the TARP program, it became clear to me that the great tragedy of the financial crisis was not that Washington failed to prevent the crisis, but instead that Washington helped lead us into it. And we were led into it based upon a single good intention, namely that every American family should own a home. Good intentions do not necessarily lead to good public policy. Washington helped lead us into this crisis in three principal ways. First, federal policies were designed to expand home ownership in an off-budget fashion by encouraging lending to people who bought homes that they simply could not afford to keep. Sadly, a federal government which lives beyond its means in turn tragically encouraged American families to do likewise. Second, Washington promoted moral hazard by protecting Fannie Mae and Freddie Mac, which privatized their profits and clearly socialized their losses. And lastly, the Federal Reserve maintained a highly accommodative monetary policy that dramatically lowered interest rates, kept them low, and inflated the housing bubble. Let's hope that history isn't currently repeating itself. Now, the Fed set the stage for a wave of mortgage borrowing by keeping credit conditions too loose too long. With the bursting of the high-tech bubble in 2000, the Fed began lowering interest rates in early 2001 to cushion the economic fallout. On an inflation-adjusted basis, or a real basis, the Fed dropped interest rates from 4% in late 2000 to a negative 1.5% by early 2003. That decision unleashed a wave of cheap credit on a housing market that was already experiencing a boom cycle. Next, the federal government has for decades attempted to spur lending and borrowing to expand home ownership without direct taxpayer spending, in other words, without annual congressional approval. I believe, and I know there are those who disagree, that one of the more damaging initiatives has been the Community Reinvestment Act, which is clearly undertaken with good intentions, but I feel is antiquated and in need of repeal. Proponents of CRA-like mandates have maintained that only a small portion of subprime mortgage originations were related to the CRA. However, I believe that misses a more fundamental point. Though they may be small in volume, CRA loan mandates remain large in precedent. They inherently required lending institutions to abandon their traditional underwriting standards to comply with this government mandate, as CRA implicitly put the government's good housekeeping seal of approval on low-quality loans. Finally, Fannie Mae and Freddie Mac, private companies awarded monopoly powers by Congress in exchange for meeting certain affordable housing goals. We all know they exploited those congressionally granted charters to borrow at discounted rates and ultimately dominated our secondary mortgage market. They wildly inflated their balance sheets and personally enriched their executives via implicit, now we all know explicit, government backing. And did I mention the cookbooks that allowed the politically connected executives to make off like bandits with what their regulator described as, quote, ill-gotten bonuses in the hundreds of millions of dollars, unquote. Given their prominence in the market, investors and underwriters came to believe that if Fannie and Freddie touched a loan, it was safe, sound, secure, and most importantly, sanctioned by the government. More than 70% of subprime and Alt-A mortgages that helped lead to the crisis were backed by Fannie, Freddie, FHA, and other taxpayer-backed programs. If you have to put your finger on the root cause of the crisis, this is it. Despite the inherent dangers in such transactions, Fannie and Freddie's congressional supporters kept encouraging them to, quote, roll the dice a little bit more, unquote. Well, they did, and the result is the worst financial crisis since the Great Depression. The ultimate consequence of these policies was that the average American family watched helplessly as their net wealth declined by nearly $50,000, wiping out almost 2 decades of financial progress. Ladies and gentlemen, this is where we have been. And 5 years later, where do we find ourselves today? Today, we all know that there are single moms throughout our economy who are having to work even harder than before simply to put food on the table, to put a roof over their families' heads. That's unconscionable. Today, taxpayers have been forced to pay for the mother of all bailouts, nearly $200 billion for the failed GSEs. That's unimaginable. Today, taxpayers remain on the hook for more than $5 trillion with a T, in mortgage guarantees, roughly 1/3 the size of our economy. That's unfathomable. Today, the federal government has a virtual monopoly on the housing finance system. That's unwise. Today, due to the Dodd-Frank Act, Washington elites decide who can qualify for a mortgage, putting homeownership out of reach for millions of credit-worthy American families. That's unfair. The American people deserve a path forward. They deserve a path to a housing system that is sustainable, fair, and preserves the American dream. They deserve a system that protects current and future homeowners so that every American who works hard, who plays by the rules, can have opportunities and choices to buy homes that they can actually afford to keep. They deserve a system that protects hardworking taxpayers so they never again have to bail out corrupted financial institutions like Fannie Mae and Freddie Mac. And they deserve a system that finally breaks the destructive boom-bust housing cycles that have hurt so many working families and brought our economy to its knees. That's why the House Financial Services Committee recently approved H.R. 2767, the PATH Act, whose acronym stands for Protecting American Taxpayers and Homeowners. I believe the PATH Act is the path forward. The act is the principal work of Scott Garrett of New Jersey, with Randy Nagelbauer of Texas and Shelley Moore Capito of West Virginia serving as its co-authors. I commend them all for their principled leadership in bringing this landmark legislation to our committee. Now, at its core, the housing market is not fundamentally different from the market for any other asset. Housing is not immune to the economic laws of supply and demand or risk and reward. Thus, the PATH Act principally relies upon private capital and market discipline. It includes 4 fundamental goals essential to the development of any competitive free market. First, the role of government is clearly defined and limited. Second, artificial barriers to private capital are removed to attract investment and encourage innovation. Third, market participants are given clear, transparent, and enforceable rules for transactions to foster competition and restore market discipline. Lastly, consumers are afforded informed choices in determining which mortgage products best suit their needs. The Act specifically does the following. It ends the costly Fannie and Freddie bailout. It protects and restores the FHA by defining its mission. It increases mortgage competition, enhances transparency, and maximizes consumer choice, and again, breaks down barriers for private investment capital. Many believe, as I do, that the first step in creating a sustainable housing finance system is to end the costly bailout of Fannie and Freddie and permanently move away from a system where the fate of our economy depends upon their success or their failure. The PATH Act ends the bailout and gradually winds down both failed companies over a 5 to 7 year time frame. Now, much of this debate has centered around the so-called need to have GSEs or their equivalent in our housing finance system. First, I think we should recognize that the U.S. is practically alone in the modern industrialized world in having government-sponsored enterprises directly guarantee mortgage securities. We are practically alone in our level of direct government subsidy and intervention in our housing markets. We were also practically alone in the world in the level of turmoil in our housing markets as measured by foreclosures and delinquencies. I believe there is a direct causal link. By almost any measure, Fannie and Freddie have not propelled our nation to housing finance nirvana. When compared to other modern industrialized nations, whether we look at rates of home ownership or spreads between mortgage interest rates and sovereign debt, the U.S. can typically be found either in the middle or the bottom of the pack. However, there is one category where the U.S. has clearly led: foreclosure rates. Only in America can you find a government that subsidizes housing more so that we, the people, can get less. But we don't have to look overseas to see a well-functioning housing market without government-sponsored enterprises. Indeed, we don't have to look any further than our own jumbo market that has successfully operated without them. Prior to the housing bust, the jumbo market was approximately 20% of our total housing market. There was capital, liquidity, competition, the 30-year fixed mortgage, consumer choice, and innovation, all right here in America. And all of that was delivered for about 7 to 25 basis points, or 1/4% interest differential, from what the GSEs offered. I would offer a modest amount to avoid taxpayer bailouts, government control, and economic catastrophe. And I think it's also important to note that whatever modest interest rate benefit the GSEs delivered to home buyers, to some extent it was clearly offset by the inflation of housing principle for those very same home buyers. In other words, it is not self-evident that the home buyer was any better off. And at the end of the day, the best arguments I have heard to perpetuate the GSEs are the following. One, they were standard setters throughout the underwriting purchase requirements. They served as loan aggregators for smaller lenders by purchasing loans through their cash window. And they provided a conduit for smaller originators to access mortgage investors through the issuance of mortgage-backed securities. These are indeed functions well worth preserving in some form throughout a new system. Thus, the PATH Act ushers in a new system of housing finance that separates out these functions, providing clear and transparent disclosure of mortgage data, giving certainty to contracts and their enforceability, utilizing the knowledge and networks of the Federal Home Loan Bank System, and creating an open access utility for mortgage-backed security issuance that is decoupled from the holding of long-term mortgage risk. To ensure a smooth transition to the new system, the PATH Act implements several reforms to Fannie and Freddie in the interim. These reforms include repealing their misguided Washington-created affordable housing goals that help precipitate the crisis, shrinking their portfolios of mortgage-backed securities and other assets, and eliminating the government-granted competitive advantages over the private sector. The PATH Act also reforms the FHA. You cannot have true housing reform without FHA reform. Otherwise, you are simply squeezing the balloon on one side only to have it bulge out on another. Regrettably, today, the FHA is not only broke, it is bailout broke. And over time, FHA has experienced severe mission creep, and I would argue the two phenomena are directly related. Instead of helping those that it was intended, today, FHA insures mortgages for millionaires and homes valued as high as $729,750. That's a mansion in most of the 5th Congressional District of Texas and far beyond the reach of those truly earning low and moderate incomes. FHA's government privileges give it advantages that muscle out private competition. So it's no wonder that FHA today controls 57% of the mortgage insurance market. It has gained this advantage over competitors by using many of the same practices employed by subprime lenders: small down payments, low credit scores, cheap upfront pricing, and encouraging the purchase of increasingly pricey homes. That's why today many would argue that FHA has more in common with the now defunct Countrywide than with the FHA of years ago. The PATH Act returns FHA to its traditional mission of helping first-time homebuyers and low and moderate income families. It further helps ensure FHA solvency. A bankrupt FHA helps no one. But rest assured that in times of serious economic downturns, under the PATH Act, the FHA will be able to insure loans to any borrower. This means that the PATH Act would preserve the FHA's existing counter-cyclical role in mortgage lending, which enables the FHA to serve as a back about 30-year mortgages. It is not necessarily the best mortgage product for a home buyer, especially a first-time home buyer. If you look at statistics and see that the first-time home buyers in this country tend to own their first home for 4 years or for 5 years, it may not be the best for their circumstances if they buy that house with that kind of timeline. There may be a different mortgage product in which they can build equity at a faster rate than a 30-year fixed-rate mortgage, unquote. Even President Obama has acknowledged that shorter duration loans hold advantages for many borrowers, such as when he proposed last year an expanded loan refinance program where borrowers, quote, must agree to refinance into a loan with no more than a 20-year term, unquote. Many Americans who seek to own a home find themselves selling their property before they build some, if any, equity in that property, leaving their situation akin to being a renter who pays thousands in closing costs, agrees to do the maintenance, and then has to pay the property taxes. There is no one-size-fits-all mortgage in America. Next, some opponents of the PATH Act claim that sufficient private sector capital simply does not exist to fill a post-government guarantee void. That begs several questions. Number one, why are equity markets 2.5 times the size of our mortgage markets, and yet they exist without any guarantee, government or otherwise? And just how much capital is sufficient for housing finance? I don't know the answer to the question, and I suspect no one in this audience does either. But what I do know is that whatever that number is, it must be sustainable. That's the key concept. And I'll also remind us all, capital has alternative uses. Every dollar that Washington artificially incents into mortgage finance is a dollar that can no longer be used to promote math tutors for our children or promote our economy's manufacturing sector to give them jobs once they graduate. Now, another important factor to remember about the U.S., about financing the U.S. mortgage market, is that investors, property and casualty life insurers, pension and retirement funds, mutual funds, and real estate investment trust held almost 50% of the market share for whole mortgages and mortgage-backed securities by 2010. For these kind of investors, the U.S. residential market is clearly an ideal investment opportunity given their need for long-term investments. As housing expert Professor Dwight Jaffe of UC Berkeley has explained, winding down the GSE should be accomplished without any major stress in the flow of funds for U.S. mortgages. And if we look abroad, we see in other modern industrialized nations that have avoided our disastrous GSE experience, private capital is ready, willing, and able to fund the mortgage market. Now, another false attack made against the PATH Act is that it will be harder for middle-income families to buy homes. No, that distinction belongs to the Dodd-Frank Act, our current law. Chief economist Mark Zandi of Moody Analytics recently testified before our committee that one single Dodd-Frank rule, QRM, currently in the pipeline, could increase mortgage interest rates 1 to 4 percentage points. Certainly, CoreLogic, a company that you know analyzes financial information, has said about half of the mortgage loans made today would not qualify with Dodd-Frank rules that go into effect this January. In other words, single-handedly, the Dodd-Frank Act could cut the number of mortgages in half and double the cost of those that remain. It's that bad. Perhaps that's why the National Association of Home Builders has warned that Dodd-Frank, quote, could grind the housing finance system to a halt. Right now, because of the Dodd-Frank Act, Washington has more control over who can buy a home than your local banker. The PATH Act addresses these devastating rules head-on, getting Washington out of the way to allow banks to lend, builders to build, realtors to sell, and home buyers to buy. The PATH Act entirely eliminates the qualified residential mortgage issue by striking Dodd-Frank's credit risk retention requirements and prohibiting federal banking agencies from requiring risk retention or premium capture reserve accounts. The PATH Act also eliminates the troubling ability to pay liability exposure for lenders for the mortgages that they are willing to hold in their own portfolio or securitized through the platform created by the PATH Act. Lastly, I know that some have claimed that somehow the PATH Act is ideological, a word that you hear more often in Washington. But it seems to me that those who would defend a failed status quo of taxpayer bailouts, economic crisis, and again, mediocre home ownership rates, perhaps these are the ones that are being ideological. Instead, the PATH Act is sustainable. Sustainable for homeowners so they can buy homes they can actually afford to keep. Sustainable for taxpayers so they no longer have to bail out finance our housing finance system again. Sustainable for our economy so that we avoid the seemingly never-ending cycle of boom-bust in our housing market. Again, perhaps in Washington that's ideological, but in the 5th Congressional District of Texas, I think it's known as common sense. And I spend a lot of time listening to my constituents and their common sense. I recently heard from Diane in Dallas, who wrote me, quote, "Why should those of us who did the responsible thing and purchase homes we could afford have to pay the freight for those who bought larger, more expensive homes they couldn't afford?" I heard from Steve in Jacksonville, Texas. He wrote me with some more common sense. If it were a mom and pop business that did what Fannie Mae and Freddie Mac did, they would have been shut down for poor business practices and even jailed. And then there's Scott from Mesquite, right next door to Dallas, who wrote me, "What the American people need is not more Washington regulations or more subsidies. Just give us the opportunity to buy a home people can afford to keep so that we can live and raise our families." So people outside of Washington get it. They understand that the system in place today is too often unfair, unaccountable, and unsustainable. Clearly, I know there are other voices in this debate besides my own and that of my constituents. And I could not be more gratified that last week the President finally added his voice to this important debate. And although I heard few specifics, I welcome him to the debate. I am encouraged by this, and I recognize that he is indispensable to a solution. Other important voices in this debate, besides your own, are those of Senator Corker of Tennessee and Senator Warner of Virginia, and I commend them for their leadership. As someone who has worked for years and years on the complicated and contentious issue of housing reform, I salute anyone who will roll up their sleeve and produce not just rhetoric, but an actual plan. And even today, more and more voices are being heard in this debate, and this is encouraging. This is good. And I stand ready to listen to all and to negotiate in good faith with all. And I do this with an open mind, but I do not do it with an empty mind. Thus, I remain skeptical and fearful of an approach that does not end the permanent government guarantee in the secondary mortgage market. If, at the end of the day, taxpayers are still on the hook, then I fear all you have done is put Fannie and Freddie in the Federal Witness Protection Program, giving them cosmetic surgery and a new identity, and unleash them on an unsuspecting public. When government provides guarantees, it means investors who buy mortgages and mortgage-backed securities will be protected against loss. They won't be overly concerned about the quality of the mortgages. Either way, they'll get paid. And not unlike Fannie and Freddie, it could very well perpetuate a system where Wall Street investors simply offload their risk on Main Street taxpayers. Such a system, I fear, can guarantee that America will face another round of boom, bust, and bailout. When I hear ideas that set up new federal bureaucracies that would approve all the players in the housing finance system, I fear the prospect of powerful bureaucrats picking winners and losers. In that system, the taxpayer always comes out the loser. And cronyism has a way of rearing its ugly head. I remain skeptical of ideas to create a new federal mortgage insurance fund. If there's one thing that we've learned about government and insurance funds, it's that the government either cannot or will not properly price for risk. You name it, whether it's the National Flood Insurance Program, which is underwater, pun intended, the Pension Benefit Guarantee Program, or even the Deposit Insurance Fund from time to time, the government has flat gotten it wrong, leaving taxpayers on the hook. I'll conclude with just these last few thoughts. As our nation charts a path forward on housing reform. Some will say our public policy choices for working American families are between house and no house. I disagree. To have a sustainable housing policy, one, again, where people buy homes they can afford to keep, the choice in many respects is between house and more house. Will our generation perpetuate a system that demands more house today only to ensure that our children are confined to less house tomorrow? Today's system of boom, bust, and bailout is retarding economic growth and helping fuel what all acknowledge is an unsustainable level of national debt. Our spending-driven debt crisis is the greatest existential threat facing our nation today. We are borrowing 31 cents on the dollar, much of it from China, and sending the bill to our children. Children born today are burdened with a debt of more than $52,000 they had nothing to do with creating. Our national debt stands at roughly $145,000 per household. For a lot of people I represent in the 5th Congressional District of Texas, that's more than they will ever amass in savings in their entire lifetimes. David Cody, one of the president's own appointees to Simpson-Bowles Commission, also the CEO of Honeywell, said, quote, "The seeds of the next recession have already been planted. The debt burden accumulated over the next 10 years will sink us." The former chairman of the Joint Chiefs of Staff, Admiral Mike Mullen, said, quote, "The single biggest threat to our national security is our debt." I would also offer the single biggest threat to our national housing aspirations, too, is our debt. So if you've ever attended one of our Financial Services Committee hearings on Capitol Hill, and if you haven't, I certainly hope one day you will also see that we run a continuous real-time display of the national debt clock. It serves as a constant and sobering reminder of the very serious and very dangerous threat that faces our nation. A threat that looms large over this debate and should loom large over every debate we engage in. And I would also say, as we think about a housing program for working Americans, we've got to remember that the best housing program, at the end of the day, is not a subsidy, not a guarantee, not an interest deduction, not even a tax credit. It's a job that leads to a rewarding career in a dynamic, growing economy, because there has never been a greater or more successful housing program ever devised by the minds of mankind than the American free enterprise system. This is what we should work to strengthen. We should also never forget that at the dawn of America's history, it was another crony-run, government-sponsored enterprise that needed a bailout, namely the East India Tea Company, that sparked a revolution and gave birth to a nation teeming with individuals who decided to take control of their own destinies. These patriots risked their lives, their fortunes, and their sacred honor to ensure that their children would have something better. In a phrase, they risk it all for the American dream, that compass that should guide us all. Today, in the aftermath of the destruction caused by an unsustainable housing finance system, we find ourselves again at another moment in history. It is a moment in history when we have to make a fundamental choice, one that will shape the future of our nation and those who proudly call America home. And that's why this debate matters. When you come down to it, it's not a debate about basis points or fixed-term loans. It's about freedom. It's about opportunity. It's about taking back control of your lives and your destinies, including many here today, you who are careers in housing finance, to have those careers without the interference of big government. I hope we can all agree it's time for a new path. It's time for our generation to preserve for our children the American dream, including that most important dream of home ownership. I welcome your voice, and I thank you for the opportunity to speak to you today. Thank you.
Mr. Chairman, thank you so much for very, very thoughtful remarks. I know we're running close to our time frame for lunch, so I'll throw a question at you and maybe a second one. But I think one of the things everyone in this room would love to know is what is your assessment of a timetable by which that which we all share, which is a desire to see this reform take place, could happen?
Well, you didn't say they would be easy questions. The House Majority Leader is anxious to bring the PATH Act to the floor. Again, I have an open mind. We are speaking to many people now about some revisions and improvements that could be made to that act before it goes to the floor. And as I look in this audience, I see a few of those people that we're talking with as we speak today. I do not have a close personal working relationship with Senator Harry Reid, so I'm a little bit ignorant of what the timetable may be over there. But in my discussions with the Senate Banking Chairman, Tim Johnson, and with Ranking Member Mike Crapo, I am cautiously optimistic that they too may move some legislation in the fall. And I believe clearly, as does the majority of the House Financial Services Committee, that the PATH Act is the path forward. But the voters spoke in the last election. There is divided government, and as I said before, that's why God made conference committees, and I wish to get the PATH Act to a conference committee.
Well, let me say that as someone who was in the Senate for a better part of a term, I only saw one or two conference committees the entire time I was there. That would be, I think, welcome news to those who study civics in our schools, that actually we could come together. And so I guess that would be the follow-up question. Do you think that we could end up in a conference situation? I mean, do you think the Senate would agree to a conference, and would the House leadership agree to a conference?
Well, to the extent I have anything to say about it, we would go to conference. You know, I've got a 9-year-old son and an 11-year-old daughter who are learning about civics, and I hope it's not relegated to myth, these ideas of having an actual conference committee. So I would remain cautiously optimistic. Again, I'm more encouraged now that the president has weighed in. I was very encouraged when the president's administration initially put out their housing white paper. I became discouraged when it was allowed to gather dust for roughly 2.5 years. I had a number of conversations with Secretary Geithner at the time. I was convinced of the sincerity of wanting to move forward. Why it never happened, I don't have a good, clear picture. But again, I'm encouraged that the president has weighed in. He seemingly wants to get something done. And option one on his housing white paper, to a great extent, encompasses much of what the PATH Act has. I listened to his comments carefully the other day. His wind down for Fannie and Freddie is quite similar to what we see in the PATH Act. Having said that, I have frequently in my career found myself agreeing with 80% of what the president says. I just find myself disagreeing with about 80% of what he does.
So there's a difference between the two. Well, one last question. Now that we come to that. So there are a number of things in your PATH Act proposal that deal really with Dodd-Frank. Is there a likelihood, do you think, that as a result of this process or a parallel process, that we might see some Dodd-Frank reform? Improvement, tweaks, by my view.
Well, I'm encouraged. I mean, it's clear that as a conservative Republican, I've not been a fan of Dodd-Frank, although I certainly have an incredible great amount of respect for its author, Chairman Frank, who clearly is one of the smarter people I've met. Doesn't mean he's right or correct. I must admit, I believe, and you'd have to ask my colleagues on the other side of the aisle, as is said in Washington, I fear some have a more religious adherence to the brand than perhaps the named authors of the act have. Personally, when you look at what the regulators have done with QM, what is contemplated by QRM, I think that is unsustainable. I do not know how you could ultimately sustain a housing finance market if you cut the number of mortgages in half and double the price on the others, which clearly could be the outcome, perhaps the worst case scenario. So I think there are a number of Democrats on the House Financial Services Committee, although they are committed to the fundamentals of Dodd-Frank, are certainly looking for room for improvement. So, you know, I've been in Congress for a few years. If you're not an optimist, it's really not the job for you. So I prefer to remain optimistic about these matters.
Mr. Chairman, thank you for your generosity with your time, and I hope you enjoy the rest of the time in your home district, which I know you prefer to Washington, but we look forward to having you back there for the important work ahead. Thank you.